Okay, do you see the handwritten screen?
Yes.
Okay. All right, so chapter 9, it looks like most people did the homework already. Just a couple of people are in progress and a few that haven't started yet. So chapter 9 is current liabilities. It's all about current liabilities, all the different liabilities, examples of what you can have. So the liability is something that the company is going to owe. I'm liable to pay. You can think about it that way. If you think about liable to pay, that goes along with accounts payable, sales tax payable, payroll payables. So anything that is under a year will go in the current liability section. Chapter 10 is long-term, so we'll do that one tonight as well. Okay, so in current liabilities, we have accounts payable, which I want to show you an example. I'm not sure how many of you are working like in an accounting department and you're able to see some of the reports, but for accounts payable, you'll be able to enter vendor names, vendor addresses, and you'll select them when those invoices come in. So if you have Entergy and you have Cox Cable, you would have their own vendor ID set up in the system, and you would select them when you go to put an invoice in. So the screen will open up, you'll say, I want to put an invoice in for Cox, you'll grab them, you'll put the information in, what the date is, what the amount is, you'll code it to the correct expense, and then you'll post it, or it'll go into a batch and you post a batch later in the day. You have different ways to enter it depending on who your software is. So this is an example of an aging report. Whoops, sorry. I don't know if it just blinked out on you. Just lost my screen, sorry. See how you have on this report, let me blow it up a little bit bigger. You'll have on here the vendor ID, and it tells you that it's Aero Furniture, and it's got these invoice numbers here. Let me check. I had to admit 2 people in, sorry. You have your invoice numbers in, they have the date, when it's due, and then it tells you the amounts. This report is like an aging report or an open payables report that you would use sometimes when you enter all your bills in the system. You may have a filing system that they go somewhere either by due date, they can go in alphabetical order. Every company does a little bit different process. But you can run these reports and you can see that accounts payable will have its own report. It'll list all of the vendors, all of the invoices, show it's due. If you had any kind of discounts that you were able to take, it would show you that as well. So it gives you a lot of information, but this is similar to what it would look like. It would list it out, show you how much, and you can see, okay, here's my total for this Aero Furniture, $49.42. Creative Business is $1,580. So it just gives you a list and compiles it, and you can go from this list to decide what are you paying that week. Sometimes you might want to wait and pay the net 30. Some companies don't wait for the terms. They got the bill, they're going to pay it. It really depends on cash flow and when you can pay your items. So I just thought that was something that I wanted to show you what it looks like. Okay, sales tax payable. If you sell in merchandise or inventory, you will have to charge sales tax. If you have a storefront or in retail, you'll have to collect the sales tax. The sales tax is charged to the customer, and then you collect the money and you just need to hold it. And so let's say the sales tax was $10. Well, it's not going to be considered income. It's only going to be considered a payable because you're just a through. What's going to happen is when you make that sale, you'll have the sale and then whatever the amount is. You'll have tax payable, whatever that amount is. And then depending on if you sold it on cash, it'll be the total. So you're not booking the tax as part of your sale. That's only going to be for your sale amount. The tax is going to be a payable to your local, could be parish and state, it could be just state. It depends on what state you live in. And a lot of times they'll have software online that you go onto their website and you can make payments. You can report your sales there and you can make the payments for your sales tax payable. So this sales tax payable is just holding the money until you're ready to go pay. In Louisiana, you have to pay parish and state. Text me. And when you go onto those websites, when I used to do it, I had to go to each parish in order to make the payments for that parish. And then I had one for the state. I think they may have upgraded that system where you can maybe do everything at once. I know like on Texas, when we used to pay Texas sales tax, when you go to Texas, they have all their county on their state website. So you were able to pay tax to your state and your county. So basically this is just a holding place, tax payable. And then when you go to make the payment, you would debit that tax payable for that amount. And then you would credit your cash because your cash is what you're using to pay for it. So the money's coming in and then it's just going right back out. It's not part of your sale. Does that make sense? Let's say I had $100 and I collected $10 from my tax payable. The cash I need to collect from my customer is $110. But notice $100 is my sale. Okay, unearned revenue. We talked a little bit about unearned revenue already. It's a liability, but it's not a payable that you have to pay money out. It's a service. It's unearned revenue. So I haven't earned that income that I've been paid. They maybe paid me in advance and I need to provide a service for them. So I might say, okay, I'm going to charge you $20,000. I'm going to do your audit and I'm going to do your tax. Well, then I have to now perform those services. And so it's an unearned revenue until I complete my work and then I move it into revenue. So again, it's going to be treated just like accounts payable, sales tax payable, just like a payable account. It would be a credit for whatever those services were, unearned revenue of $20,000, and I collected the money. So here's my cash. Haven't performed them yet, so it's going to sit as a liability on the balance sheet. And when I perform those services, let's say I got paid in January and I finished everything, everything's completed by May 1, I turn around and on May 1, I'm going to do an adjustment to my books and I'm going to clear out that unearned revenue with the debit. And then I'll credit my revenue account, whatever that might be, services for accounting or tax, however you have it broken out in your general ledger chart of accounts. So that's unearned revenue. Then we have short-term notes. You might have something that you have to pay for like 3 months and it's going to be the same payment each month. You'll have payroll liabilities. Just when you get paid, you usually get paid once every 2 weeks, maybe once a week if you're lucky. So when you're working, the employer is going to have to accrue some of those payables that come through payroll. We're going to do an example of this tonight. And they'll also have to accrue that salary that they haven't paid yet, and that'll be a salary payable. So maybe I worked at the end of the month, but I'm not getting paid for that until next month. So the company will set up the expense and recognize the expense in the month that you worked, and it sets up as a sales tax payable. I'm sorry, a payroll tax payable. Sometimes we have vacation estimates. We have bonus estimates, and we'll set those up. We have warranty. If you're selling a part, or a vehicle or maybe a lawnmower, a lot of times you'll get a warranty. So you know how sometimes when you go buy some equipment, maybe a lawnmower, and they tell you got a 12-month window that you have a full full warranty, so you can return it if something goes wrong. Well, they usually will estimate an expense on how much they're going to be paying out on this warranty. You want to try to recognize with the recognition principle, you want to recognize the expense when you have the sale. So when they sell that equipment for that month, they may want to recognize the expense during that month. Okay. So let's see, let's go to the homework. Let me share this screen. We're going to do number 2 on chapter 9. We're going to look at number 2. Okay, listed below are a few transactions and events of Piper Company. Piper Company records a year-end entry for $10,000 of a previously unrecorded cash sale costing $5,000 and its sales taxes at a rate of 4%. The company earned $50,000 of the $125,000 previously received in advance and originally recorded as unearned service revenue. So I'm seeing that we have a cash sale, we have sales tax payable, and then I also see that we have some unearned revenue. All right, prepare the necessary journal entries at December 31 for Piper Company. Year-end financial statements for each of the above separate transactions. So Piper Company records a year-end entry for $10,000 of a previously unrecorded cash sale, and we charge 4%. Well, I know that I have a sale of $10,000, and that's a credit. So then I want to take the $10,000 and I want to multiply that by the 4% so that I can put the sales tax payable in there and I can collect that. So now I have sales and sales tax payable for $400, and I'm collecting cash of $10,004. It's telling me that it costs $5,000. So not only do I book the sale, but since I've sold some merchandise, I have to remove the merchandise and I set up the cost. So my debit's my cost of goods sold, $5,000. I'm setting up my credit to inventory because that is no longer available to sell. So I want to make sure I clear that out. $5,000 credit. And then I have unearned service revenue. So it's saying the company earned $50,000 of $125,000 that was previously received. So they're not asking you to record the entry where you receive the cash. They're asking you to record the entry to recognize the $50,000. So initially, when you set up the unearned revenue for the $125,000, the $125,000 you're going to receive cash. So my debit's going to be cash. The credit's going to be unearned revenue for $125,000, and it's sitting as a liability. Once I do the $50,000 service, I want to make sure to clear that and reduce my unearned revenue so it doesn't look like I owe $125,000 worth of service. So I need to do the opposite, which is debit. And that's what the entry number 3 is. Unearned service revenue is a debit for $50,000, and I'm a credit earned service revenue for $50,000. Do y'all have any questions? Okay, number 3. Okay, Sylvester System borrows $136,000 cash on May 15th by signing a 120-day 5% note. So you see that this is something that is less than 12 months. So it would be considered a current liability, and it would go in the current liability section of the balance sheet because it's only for 120 days, and it's 5% note. So on what day does the note mature? So it's got the date, oops, I got the date on here, September 12th. What you want to do is take May 15th and you want to count those days, 120 days. So you look to see, you know, how much you have each month in those days. And it comes up with September 12th. Assume the face value of the note equals 136, the principal of the loan. Okay, so now I'm getting the money. I need to set up my cash. I'm debiting 136,000 cash and I'm crediting notes payable. So now I'm setting up 136,000. Prepare the journal entry to record the issuance of the note. So that was that. Okay, and then B, first complete the table below to calculate the interest expense at maturity. Now it tells us that they're charging us 5%. So it set up the 136 times the 5%. But are we charging a whole year? We're not. And remember that the formula for banks is using 360 days. So we're going to take 120 days, because that's how long we have this note, divided by the 360 to get what the interest is. Use those calculated values to prepare the journal entry to record the payment at note maturity. So the note is going to be 136,000. On top of that, I have to pay 5%. I just calculated out what the interest is going to be. So I need to expense the interest in full, the 2,267, which we just calculated. And that goes as a debit because it's an expense. My notes payable, I'm now going to clear that off because I'm paying the money out, which is 136,000. And then my cash going out, I have to add them together. So the main thing to note on this when you're doing your notes payable is don't forget that when you debit the notes payable, you want it to only be for the amount that you receive. Don't include the amount for the interest. The interest is separate and it goes to interest expense. So your credit is going to be cash for 138,267. Okay, let's do number 4. So 4 has got 4, 5, and 6. BMX company has 1 employee. FICA Social Security taxes are 6.2 for the first 127,200, and FICA Medicare are 1.45 of the gross pay. For BMX, its FUTA tax are 3.1 and SUTA tax are 2.9. So this is your unemployment tax, federal and state unemployment tax. And it's only on the first $7,000 paid to the employee. So we have 3 here, A, B, and C. So 3 different scenarios. The first one tells me I have $5,300 to pay on August 31, well, paid through August 31. And the pay for September is $2,600. So on my pay is what I'm going to use to make my calculations. So here's A. In the table, we're going to start with our FICA, Social Security, and Medicare. It's going to be $2,600 times the rates to get the amounts. For FUTA and SUTA, notice I'm not using the whole $2,600. So remember that it tells you it's only on the first 7,000. It's already been paid. They've already been paid $5,300. So we have $5,300, and then what's the difference between the $5,300 and 7,000? It's $1,700. So I'm going to use $1,700 instead of the $2,600, because anything over 7,000, I don't need to pay money on that. I don't have to pay tax on that. So I'm going to use the $1,700 and multiply it by the rates they gave me, and that's my amount. All right, so let's look at B. B says they've only made $1,700 through August. We're paying $2,900. Well, $1,700 less the 7,000 is $5,300. So I can pay the tax on the entire $2,900 for my FUTA and SUTA. So you'll notice in this example, it's $2,900 for all 4, and that's why. C says I have 120,100 that I've paid out so far. And it tells me, let's see what the number was. For the first 127,200. So the difference between the 127,200 and the 120,100 is $7,100. So I only have to pay that 6.2 on the $7,100, not the full amount that I'm paying of 8,800. And that's why, because I'm taking the difference. I've gone over the 127.2, so I only want to go to that point. So that's where the 7,100 comes from to multiply by the 6.2. I use the amount they gave me, 8,800 for the 1.45, and then I'm already over 7,000 because I'm at 120. I don't have to charge tax on the other two. Okay, so that's how we do that table. Now it's saying, assuming situation A, prepare the employer's September 30th journal entry. Now keep in mind, you're going to have the employee deductions and you're also going to have your employer tax deductions. So we're going to do both. So this one's saying to do employer September 30th journal entry to record the salary expense and its related payroll liabilities for this employee. Okay, so let's look back up here at A, and I could see all my tax amounts here. All right, so, oh wait, I don't want to do the journal entry yet. I want to show the table. Okay, so we're doing FICA, Social Security, FICA, Medicare. We have the 2,600 on both, and here's the amounts. The federal income tax, they're telling me, this is where this is coming from. The employee federal taxes withheld from the employer is $70. So there's a table that is usually downloaded into the payroll software that will calculate how much you should take out in federal taxes based on the federal tax schedules for that year. So they're telling us the amount. They're keeping it easy. We don't have to look up anything. So we have $70 for federal income tax, the 161.20 and the 37.70. So we have 268.90. Journal entry. The salary expense is going to be what we have to pay out, this $2,600. So here's our $2,600. And then we have FICA, Social Security, Medicare, 161.20, 37.70. We have the employee federal income tax payable of $70, and then their payable amount to the employee. This is their net, their gross minus the tax is $23,31.10. So we're setting up the salaries payable because we have to pay that to them. Let's see, I think that was the whole part for 5. Okay, and then 6 says, assuming the same situation A, prepare the employer's September 30th journal entries. So this must have been, yeah, for the employee. And then this one is setting it up. Payroll taxes as related to the liabilities for the employer. So number 6 is the employer's taxes that they have to pay. So the FICA and Social Security and Medicare, your company has to pay that as well. So you're withholding the money on the payroll check for the employee's payment, and you're also setting up, you're gonna have to set up an expense for your payable that you have to pay, which is the same rates. So we have Social Security and Medicare, and then we also have the unemployment taxes, the 5270 and the 4930. And so here's my total expense, 390. So some companies will have one payroll tax expense account. There are other companies that may break all of those out. You might see one that's labeled federal unemployment, state unemployment, expense accounts. It's just a preference on how you want to set it up. All right, so here's my entry. I know the total of my expenses is $390, $300.90, sorry. And then my credit is all of the liabilities that I have to pay out. So FICA, Medicare and Social Security, there's my 2 amounts for credit. And then here's my unemployment taxes. And there they are to pay out. You should always see that each one of these has its own payable account. Because you might not be paying the same place, and it's easier to keep things reconciled if they're in different payable accounts. So if you're starting your own business, you have QuickBooks and you're setting up all these accounts, you want to set up each one separately as a payable account. And that way you have them in their own spot, and then you know, okay, here's everything that went in as my payable, and here's the payment that went out, and you can see that it clears. It's easy to reconcile if you have them separated. So that's an example of what happens with payroll and your liability for your taxes. So just keep in mind that the employer is paying taxes, and then the employee is also paying taxes. All of the taxes that are withheld from the employer is a tax payable, and you have to pay those on time. There's a lot of stiff penalties if you don't pay your payroll taxes on time. The government's pretty strict about that. Okay, number 14. Again, I think this one's going to be a multiple part. Okay, on October 29th, Lobo Company began operations by purchasing razors for resale. Lobo uses the perpetual inventory method. The razors have a 90-day warranty. So we're going to set up something as an expense to make sure that we know we have some allowance there. So if we have something that comes back under warranty, we're just going to try to clear that account out. All right. When a razor is returned, the company discards it and mails them a new one from the merchandise inventory to the customer. The company's cost per razor is $15, and retail selling price is $80 in both years. The manufacturer has advised the company to expect warranty costs equal to 7% of the total dollar sales. All right, here's my transactions. So on number 1, it says to prepare the journal entries to record the transactions for the year 2017. So we're only going to focus on this top part for the part A. So on November 11th, we sell 70 razors for $5,600 cash. So I'm going to record my sale. Cash $5,600, sales $5,600. Cost of goods sold, and remember they gave us the cost. They're saying the cost of the razor is $15. So it should be, how many did we sell? 70. Let me just check the math. Make sure I'm telling you correctly. Yep, 1050. So your cost of goods sold is $15, which is given to you. Multiply it by the number of razors, that's my cost. And then I need to credit my inventory because I'm selling my inventory for $1,050. Next, it says recognize warranty expense related to the November sales with an adjusting entry. So I'm making an adjusting entry to set up the warranty expense on the ones that I just sold. The information is given to us that it's 7% of the total dollar sales. So I'm going to take the 7% and multiply it by the $5,600 to come up with my amount that I need to set up as my warranty expense and my warranty liability. Warranty expense $392, and I'm going to credit the liability account $392. That's going to stay on the books, and they probably have a method of leaving it on there for a period of time, and then they would, they may wipe it off at some point. But what we want to do is make sure that if something comes back and is returned, we're using that account, not cost. All right. So on December 9th, we replaced 14 razors that were returned under warranty. So remember, I'm sending 14 razors out from my inventory. So I have to calculate what my cost is on that. So it should be the 14 times 15. So 210. So here's my estimated warranty liability, 210. Now I'm doing that instead of cost of goods sold because I'm replacing some that came back. So I want to reduce that liability account. And then I also need to credit my inventory because I am sending those razors out. So I need to remove them from my inventory. December 16th, I sold 210,000 razors for 16,800 cash. So I received my cash, I got my sales. My cost of goods, I'm taking that 210 razors and multiplying it by $15 to come up with my cost. So my cost is $31.50. I'm relieving my inventory, so I'm crediting merchandise inventory for $31.50. December 29th, I replaced 28 razors that were returned under warranty. Okay, I have 28 coming back. So remember that I'm not going to cost with those. I'm going to go to my liability account. So I'm debiting my estimated warranty liability, $420, and I'm crediting my inventory for the parts that I'm sending out, which is $420. And on December 31, I want to recognize the warranty expense related to the December sales. So my December sales was 210, and I want to use the 7% of the sale amount, which they tell me was 16,008. So I'm gonna take 16,008, multiply it by the 7% to come up with the amount that I want to expense and set up as my liability. So my warranty expense is a debit, $11.76, and then I'm crediting my warranty liability for $11.76. So if we wanted to look to see what do we have left in that warranty liability account, we can go through these transactions and calculate it out by looking at what was set up first was the $392. And then I had a debit for 210. So that's reducing my account. I'm down to 182. And then with this entry, I'm reducing it by $420. And then I'm also setting up 1,176. And so my credit in the account at the end of 2017 is $938. So you're just going through the transactions to see how much did you set up as a liability, and then how much did you have to send back out as a replacement, and you just deduct that amount because those are your debits. Okay, so for B, prepare journal entries to record 2018. Go through the same steps. Sold January 5th, sold 140 razors for $11.20. Setting up our sale. Our cost of goods, we're using the same numbers. So we take 140 and multiply that by the $15 to come up with our cost. Credit the inventory. Our estimated warranty is going to be the $11.2 times 7%. So it's $495. We're going to credit the inventory because we're sending those razors out. And then we're recognizing the expense on the January 31st date. Warranty expense, which is a 7% of the sales, $784. And then we are crediting the liability account. Okay, so how much warranty expense was reported in November 2017 and for December of 2017? So you would just go back to those two transactions. So what did we set up as a warranty expense? It is A for 2017. So we're looking at November transactions, and you only want to look at this one account, warranty expense. I set up $392. What did I set up in December? So I'm going through all my December transactions, and I'm looking for the warranty expense, which is here, $11.76. So that's this answer. 16 says, how much warranty expense is reported in January of 2018? Again, go through the transactions, look for warranty expense, and find how much you calculated, $784. What's the balance in the estimated liability account at December 31? We just calculated that, $938. What is the balance on January 31? So now we have to go back and look at the 2018. So right now I have a credit balance at the end of 2017 of $938. I set up a warranty expense of $784. So I'm going to increase my $938 by that. And then I also had to send out some razors that were bad under warranty, $495. So I'm going to subtract that because it's a debit. So I have 1227. And there it is. And right here, it's showing you what I just did on the calculator. So we had a beginning balance of 938 credit. We set up the warranty of 784. We replaced them 495, and we have an estimate of 1227. So that is chapter 9. Some of the examples. There are other problems in there that are similar to what we just went through. Let's look at chapter 10. Chapter 10 is long-term liability. So anything over a year, this is going to be companies that will issue bonds, and then you may have something that you have a long-term notes payable or even a mortgage. My company owns buildings, and they're commercial buildings or commercial office buildings, or they could be retail buildings. We have a mortgage on some of those buildings. So that's a long-term notes payable that you want to show up on the balance sheet under your liability section, but it will be under the long-term liability section. So bonds are issued by companies, and there's different reasons why they may do this. Is maybe they don't want to get a loan from a company, a bank. Maybe if they got a loan from a bank, the interest would be high, and maybe they have to report all of these different reports to them quarterly, and they don't want to do that. Maybe there's different reasons why they wouldn't want to go through the bank. So if I'm getting ready to expand, let's say I have a plant and I'm getting ready to expand and build a new plant, I need some cash to come in, and eventually that plant is going to be producing and bringing more income in. So I know that the income can pay back that loan, but I don't want to do the loan with the bank. I don't want to have ties to them. I don't want to have all of those reports to be done quarterly. So I decide I'm going to sell bonds. And what you do is you open it up to the public to be able to buy bonds in your company, or you can do governmental bonds. And so what happens is they'll put them on the market, and you'll buy them, and you'll get paid. It could be 4 times a year, 2 times a year. It depends on how the bond is set up. We'll look at a couple of examples when we do the homework. And so for me, I might spend, $10,000 on a bond, and then for the next 5 years, I'm going to get a payment twice a year for interest on the $10,000. And each time they make me the payment, it's going to be whatever the percent is for the year, times that divided by 2, and I'll get that payment twice a year. So I have a little income coming in from my bonds. And then at the end of the term, which could be 4 years, 5 years, I'll get my $10,000 back. That's how the bonds work. Now, sometimes the bonds will sell, they call it par value. Par value means that it's if it says that it's a $100,000 bond, you buy it for $100,000, and the value of what you spent on the bond is the same, and that's called par value. The market is 10, you paid 10. It's just an even bond trade, and so it's called par value. Now, bonds are also sold at a different rate than what the face value is. So maybe I have a $100,000 bond, but I'm selling it for 95%. And I'm doing that maybe because I want to get the money quicker, and they're gonna get their money back, but it's better for the person that's buying the bond to buy it for cheaper, and it works out better for you. So if I decide to do that and I sell the bond at 95%, then I'm selling it lower than the market. It would be called a discount. Okay, so if I'm selling the bond less than the face value, it's called a discount. If I decide to sell the bond greater than the market value or the face value, then that's selling that bond at a premium. Do y'all have any questions about that? No? So the discount means that, let me see if I can find the wording on it. So I don't, let's see. It tells me on this. I'm looking at the notes right now to see if it has what I'm trying to say. I was wanting to tell you what the interest rates. So if I sell it at a premium, then the interest rate that I'm offering on the current market rate is going to be higher. So let's say the market interest rate is 10% and I sell the bond and say I'm going to give you 12%. So I'm selling it at a premium. The discount would be the opposite. The current market may be paying out 10%, but I'm going to have a bond for 8%. Okay, we're going to do some examples from the homework with that to try to help walk through how to do the calculations on the bond. Y'all don't have any questions about what the bonds are? Do you kind of understand what the difference is between the discount and the premium? Okay, I guess we're good. All right, so long-term notes payable. We talked a little bit about that. It's just basically the same thing as borrowing money on a short term, but let's say I have a long-term notes payable. I'm going to set it over a period of time. I'm going to have installment payments, paying interest and principal. And instead of sitting on the balance sheet under the current liability section as a, you know, maybe loans other or something, it's going to be sitting in the long-term liability section under notes payable, or it could say mortgage payable if you have a mortgage. All right, so let's look at homework number 1. All right, TANO issues bonds with a par value of $93,000 on January 1. The bond's annual contract is 7%. The interest rate paid semi-annually on June 30th and December 31. The bonds mature in 3 years. The annual market rate at the date of issuance is 8%, and the bonds are sold for $90,561. So the par value is $93,000, and I'm selling it at $90,561, which means I've sold it at a discount. So it says, what is the amount of the discount of the bonds at issuance? So the difference between the 93,000 minus the 9561 is going to give me the amount of my discount, $24.39. How much total bond interest will be recognized over the life of these bonds? Now, keep in mind, we're gonna have to calculate that out, because you're gonna pay the interest, and when you do the calculation for the payments, you're gonna do it on the face value of the bond. So the bond is 93,000 and the interest rate is 7%. So we need to calculate that out. So we're gonna have 6 payments and it's $32.55. The way you would figure that out is take your 93,000 and then multiply it by the 7%, which will give you $65.10 for the year. Divide it by 2, because you're gonna have 2 payments for the year, and you come up with your $32.55. 6 payments is because you have 2 payments per year and there's 3 years. So how much is that? $32.55 times 6, that gives me my total that I'm spending out on the interest for the life of the bond. And then I have my par value, $93,000, Total repay is, you gotta add them together, which is 112,530, less the amount that I borrowed. So remember, I'm borrowing money from people that are buying the bonds, which is 90,561. So my total expense is for the year is more than just that 19,000. And the reason why is because the difference between the par value and the amount that I sold the bond for, that difference is going to get expensed over a period of time. Hopefully that makes sense. So we know the 19.5 comes from the payments. When you're calculating your payments, remember to grab the par value amount, not the amount that it was sold for. Par value amount times the rate, just 7%, and then you would divide it by 2 because it's semi-annually, times 6, that gives me the 19.5. And then the additional money, so if I took the 19.5 and then I added it's 19,530 plus the 2439, 21,969. So they show you how to work it out here, but all it is taking your payment interest and then adding the difference. And then the total is what your expense is. This is how you calculate it for discount, not premium. Okay. All right. Prepare an amortization table using the straight line method to amortize the discount of the bond. So we're going to go straight line, which just means divide it by the number of payments, and it'll be that the same over time. So we're going to take the 2439 is what is unamortized. The carrying value is 90,561. Over a period of time, as you continue to expense, that value is going to go up. And at the end, it's going to go to the face value of the bond, which is 93,000. So you want to take, let's see, then 2439 divided by the 6 payments, which is 406.50. I don't know if they show you. They do in 407 down here. So what happens on the first date, 1/1/18, this is when you have the selling of the bonds. So you have your unamortized discount, 2439, your carrying value, 90,561. On 6/30, when you make a payment, you're going to reduce that, right? Because you're making a payment and you're only reducing it by the 407. So you'll have the 2439 minus 407. Now your unamortized discount is 2032. And the 407, if you look here, it's straight line. Remember, it's straight line. So take the 2439 divided by the number of payments to come up with the number. So I came up with 406.50 and it rounded it up. So it may tell you to round up on the problem. So if you're getting it wrong for whatever reason, just make sure it's not rounding. So you would plug in your number. So this number 2439 is going to be reduced by the 407 each time you make a payment. And that's why it's going down to 0. And your carrying value will increase all the way until you get to that 93,000, which is the face value. All right, let's look at number 2. Okay, so we have 7% 2-year bonds on December 31, 2018 with a par value of 102 and semi-annual. So we're doing 2 payments a year again. Use the straight line amortization table to prepare the journal entries for the following. So I have an amortization schedule set up, 12/31/2018. It tells me that I have unamortized discount of 6,040. My carrying value is 95,960. So I have 2-year bonds and I have 2 payments per year. So I have 4 payments of the interest, which is, let's see, let me go clear that out. Okay, the base value is 102,000 times the 7%, divided by 2. So 3570 is going to be my payment. Let me see where it tells you to do that. It's going to be B. All right, so let's just look at the journal entry real quick from when we sold the discount. So it tells me the par value is 102. That's what I want to set up my bond payable for, the 102. So the payable is going to match what's the face value. The cash is what I actually received. This schedule is showing that I received $95,960. So it's less, you know, you have a discount. So my cash that I receive is $95,960. The difference is what is my discount on bonds payable. So it's $6,040. I'm going to be reducing that and expensing it over time. So I'm going to do an entry each time I make a payment. So we're going to go through that. The first 4th interest payments on each June 30th and December 31. All right, so on June 30th, we just calculated by taking the 60/40. Let me find where I put that in. I thought it was 60/40. No. The difference between the 102 and the 95,960 is 60/40. And
I got it like in the first 2 numbers on the go back up
right here.
on the chart where it says amortized discount. I subtracted the first 2 numbers, and that's how I got the discount on bonds payable.
Okay.
I don't know if that would be easier for some people if they don't have, because you won't necessarily have all the numbers at first all the time, like the
Right. Right. So the payment, it doesn't show you that calculation on this 3570. That's what I was looking for. Well, it does. It's just down here. You have to know to divide it in 2 to get it. So remember, we just went through the payment. It's going to be based on the face value. You have to know that number, and it's not showing you in this table. So you want to do the 102 times the 7% to calculate out what the interest is. Remember to divide it by 2 because you're going to have 2 payments for the year. That's where the 3570 comes from. So that number you can figure out, and you know that you have to pay that number out. And that's what this credit is for cash for 3570. So it might be good to know that you need to set that up that way first, because you know that cash is going out. The bond interest expense, so I need to take my, let's see, 60/40, and I need to divide it by 4 payments. So it's $1,510. That's another credit, because remember when we set it up, when we sold it, it was a debit to payable, discount on bonds payable. So we're gonna have to credit it to reduce it, because we're reducing it as we go. What's the expense? So remember I said the difference between what you sold it for and the face value of the bond, that difference is also going to get expensed into interest along with the payment. That's why you have 50/80. You're adding them 2 together. So you got to calculate out your payment, and then you have to calculate out what is the portion that I need to expense for the unamortized discount. And that's just taking the amount of the difference and dividing it by the number of payments, which is 4 in this example. So that's how we set it up for the payment. Okay. Then on December 31, we're making another payment. So it's the same exact entry. 3rd payment on June 30th, 2020, same exact entry. 4th payment, same exact entry, because all we're doing is straight line. It's divided evenly amongst the payments. So that's why they're all the same. Okay, so the maturity of the bond at December 31. So what do I have left on the books? I started with discount on bonds payable, debit $6,040. Well, what did I just do over the course of the 2 years? I've reduced that, reduced it, which means this payable is now gone. I don't have it left. And I've expensed what I needed to expense, and that closes at the year end. So what do I have left? I only have the bond left right here, the 102. So when I make that payment back out to the people that bought the bonds, it's for the face value. So remember I said it works good for you if you can buy on a discount because you paid the 95,000, but you're getting 100,000 back, plus you're getting the interest along the way. Okay, so here's my entry. I'm debiting bonds payable 102, crediting cash because I'm paying cash out. Okay, number 3. Okay, so we issue bond dated January 1 with a par value of 720,000. The annual contract is 10% and the interest is paid semi-annually, the 30th and 31st. The bonds mature in 3 years. So we're gonna have 6 payments. The annual market rate is 8% and the bonds are sold at 757,732. Okay, so we know we have a premium because what we collected in cash is more than that face value. So when we set up the entry, when we record it, we know that we're recording what we received in cash, but that bond payable is only going to be the face value. Okay, so it wants to know what is the premium. Well, the premium should be the difference between what we actually collected, which is the 757,732, less the face value, which is 720,000. So 757,732 minus 720. Let me just make sure I get the same number. Yeah, 37,732. So you want to just take the difference. Okay, we have 6 payments and I need to calculate what is my payment going to be. My payment's going to be the 720,000, which is the face value, multiplied by the contract rate, which is 10%. So 720,000 times 10%. And then remember, I'm paying 2 times, so I have to divide it by 2 to get 36,000 per payment. Okay, so then I have 6 of those because it's 3 years. So I have 6 payments times 36. It gives me 216,000. The par value at maturity is 720. The total money that's repaid out, 936,000. Less amount that was borrowed is 757,732. My total bond interest is 178,268. So now what's going to happen is it's going to reduce my expense. So each time I have a payment, because I sold it on premium, that difference that I collected in cash is going to reduce the expense. So remember the discount, the difference we put into expense, this is going to be the opposite. So the way that the entry is, you'll see that it's pretty much exactly the same way, except that instead of having discount as a debit, you're going to have a premium as a credit. All right. So part 3 says prepare the amortization table. Hopefully I have an example that goes through the journal entries. All right, so here's my 37,732 that was calculated out for my unamortized premium. And I want to reduce that as I go, and I'm just doing straight line. So I'm taking the 37,732, dividing it by 6 payments. So they're probably going to round it up. They did 62.89. It's going to be the amount that I'm reducing at each time. So each time I make a payment for that 62.89, I'm going to reduce the amount. So 37,732 minus the 62.89 gives me a 31.43, and just keep doing that all the way down. The carrying value is going to reduce because remember, we're starting high because it's a premium. So instead of adding 2 and building up to the face value, now we're going to be deducting and going down to the face value of 720,000. So a lot of it's the same steps, but just remember that it's going to be the opposite. You're getting a little more money than what the face value is. But when you calculate that payment, make sure you use the face value. Face value times the contract rate. And that's your payment divided among how many payments you have. And then it's going to reduce the expense of that payment. that difference that you collected versus what the face value was. Okay, so let's see. The next problem is number 7 that I wanted to do. Okay, so on January 1, 2018, Company borrows $270,000 from the bank and signs a 4% installment note for 5 annual payments of $60,649 each, which is the first payment due 1 year after the note is signed. So we're going to prepare the entry for the note. So when we receive the money for the note, that's the easy part, right? We're going to set up cash as a debit for $270,000, credit notes payable for $270,000. So we're not doing anything with interest yet. We're just setting up the money that we just received, and we're setting up the notes payable. And then it tells us for the first $60,649 annual payment at December 31, what amount goes toward interest expense, what amount goes towards principal reduction of the note. Okay, so it shows you down here that how to calculate it out. So you take your 270,000 times the 4%, and that's going to give you 10,800, which is your interest expense for the year. And they want the annual number. So that's why we're going to keep that number, because it's the annual. So we have 10,800. How much did it tell me my payment was? The payment is 60,649. That's not going to change. That stays the same. So I need to back into my principal. So I'm just taking the number that they tell me the payment is, and I'm subtracting the interest expense, which I calculate. The difference is what goes to my principal. So when I make the payment and I do the journal entry, then I'm going to set up my payment. It's going to be my cash going out. So I know that I have a credit for cash for $60,649. I know that I have interest of $1080. So I needed to go to interest expense as a debit for $10,080. And I want to reduce my notes payable, which is sitting on the books as a credit. So I'm going to debit notes payable for the difference, which is $49,849. And that'll reduce it as you go. Okay, number 8. All right, number 8 says, the company issues 10% 10-year bonds with a par value of 260 with a semi-annual interest on payments. On the issue date, the annual market for these bonds is 12%, which implies selling at 88.5. So we're doing the same thing, but we are going to look at it a little bit different. The numbers are showing up a little bit different. The way you calculate things is the same. We're just going to look at it a little bit different. Okay. So par value 260, we know that. We're going to multiply it by 88.5%. So since it's not a full 100%, we know we're selling it at a discount. So the selling price is $230,100. So instead of saying what it was that you sold it for, now they're just making you calculate it out. They have a table. So you will have 2 tables that you go to for your present value to figure out what the present value is. You have the 260,000 maturity date. Now you're going to figure this out by your payments. So if I have, let me go back to this. I'm paying 10% for 10-year bonds. So I'm going to have 2 payments per year, which means I'm going to look in the table for 5% and 20 years. Because I'm going to do that. Is it 5% and 2%? Let me see. Let me make sure.
Yeah, I was confused about that.
Yeah, let me make sure I'm telling you right. But I think you have to divide the percent and then double the year, if I'm not mistaken. So let's look at table B first. So 5% at 20 is a 12,4,622. Is that what it had?
Yeah, that's right.
Oh, I went to the wrong spot. Nope, it's different.
You divide percent and
Wait,
then,
let me just, I gotta make sure. These are a little bit confusing, but okay, I said it was 10%, so 5 20.3769. If that's not right, then we'll back into it. Okay, so it says 3118. It's this one. So it's what did we're using the market. I'm sorry. It's 12%.
Is that one?
Yeah. Okay, so we're using the annual market rate of 12%. I'm sorry, I gave you the wrong percent. So it's going to be the 6%. Use the market, and then you're doing that because you're making a payment semi-annually, so you have to cut it in half. So it's going to be the 6%, and then you go with the 20. You're doubling the number of years. That's how you figure it out. So the first one is 6 and 20. I think it was this table. 6 and 20, the 11, 4, 699. That's the second one. Let's see. Yeah, that's right.
2 payments for the year.
Yeah. Okay. So 6% and then 20. So I wanted to go over this one mainly because I wanted you to know how to get to the number from the table. These aren't my favorite.
It's the same for both tables. On number 10, it's the same
Same
price.
thing? Okay. Well, that's good. I don't know. I mean, I know that it changes the numbers, so I don't know if it's going to change the percentage.
Yeah, the percentages are different, but like the process to get to, because I couldn't figure out how to get the numbers I needed off the tables, but I went back to number 8, and that's how I figured out how to do number 10.
Okay. Yeah, so take the market rate, divide it by 2, because you're probably only going to have semi-annual payments, and then double the amount of years. And that's how you get your numbers and plug them in.
Okay. On the chart, it says periods. Like on the left side of the chart, the table, it says periods, and the top is percentages.
Because it's
the semi-annual periods. That's why.
Right.
I said,
right. Yeah, because you're paying twice.
Periods for each year. You have, so if it's 10, then it's 20.
Right. You double it. I don't think I put anything in here other than 2 payments per year. I think I used the same thing for each one. Okay, so number 9 is prepare the journal entry for the issuance of the bonds. And assume that the bonds are issued for cash on January 1. So it tells us when we calculate it out, 260 times the 88.5%, that's 230,100. That's what we collected. So that's our cash debit. And then we're selling for a discount, so we're going to have a debit. And it's going to be the difference between the 230,177 and the 260. So that's 29.9. And then the bonds payable has to be for the amount of the face value, which is 260,000. Now, if this was a premium, then your cash would be higher than that bond payable. So let's say it was 270,000. You would have cash of 270,000. You would have a credit for your bond payable for 260. And then you would have a credit for your premium on bond payable for 10,000. So these two would be the same debit and credit, except the cash obviously will be different. But the discount is a debit, and then when you're doing premium, premium is going to be on the credit side. And the reason why is because over time you're reducing your interest expense. So you're going to debit the premium on bonds for that payment, and then you're going to credit expense, interest expense. It's going to reduce it down. I don't know if I have a journal entry problem with premium in the homework, and I'm not sure if it's going to want to net it or if it's going to want you to show the payment interest in that amortization of the premium, net it together, or if it's going to want it to be separate. I'm not sure how it's going to ask you to do the journal entry. I can't remember. Do you remember if there was one with a premium to do the journal entries?
It is. I think it's number.
So we did number 3, and then we went to 7 and then 8. So it might be, let me look at 4. No, that's not the right one. That's just doing a formula. So here's your discount
Hey, check
again.
number 6.
Okay, number 6.
Yeah, number 6.
Yep, there it is. So here's what your entry is going to look like. Your bond interest expense. It's just netting it. So your whole, okay, so let's see where the calculations are to tell you. 440,000 times 0.075. So 16.5 is the amount that you're paying out each payment. And if you notice, your expense isn't 16.5. It's less. So it's netting it out. It's taken that 28.15 away from the 16.5. Let's see. And so, but what's happening is you're basically expensing the payment of the 16.5, and then you have a credit to the expense for that premium amount of 28.15. And so then you just offset them together, and the difference is what's getting debited. So it's not the full expense. Okay.
Like I realized with like this one, with if the par value is less than the issue price, then you go in the opposite direction. You subtract instead of adding.
Right. Yep, because it's a premium. Yep. So these can be a little confusing when you see them the first time. You may have to work a few problems before you do them on a test. Know how to do both. If it's sold at par value, I don't think I have a par value in here. I was looking at the homework and I'm like, I don't know why I don't have a par value. I didn't see one. I don't know why I didn't put one. But the par values are easy because you won't have, you know, all the difference that you have to amortize over the period of time. If you have a par value, you sell it at 440. Well, then what happens is when you do your initial journal entry, which this one doesn't have it, it would be the cash for the 440, and then it would be the bonds payable for 440, and that's it. And then you would calculate out your payment, which is what it does here, 440 times the 0.075 divided by 2 to get your payment, 16.5. So then your entry is real easy too, because you know this is your interest. So your interest expense debit, 16.5, cash credit, 16.5. And that's it until you're finished. And then when you finish paying, then you do the same entry that you do on either one of these, which is you're paying out cash of 440,000 and you're debiting your bonds payable at 440,000 to remove it off the books. So your bond, once you set the bonds payable up, initially when you make the sale of the bonds, it stays until maturity or you call it back. So once it goes to maturity, then you want to clear it off the books. I think this number 11 is the call. So maybe we have in there that we can call it back early. We can pay it off early. Let's see, number 11. And so this is what I think this problem is. On July 1, Advocate Company exercises a $6,000 call option plus par value on its outstanding bonds that they have carrying value of 309. So the carrying value is what's left on the books at that point in time, which is going to be a combination of discount and premium on bonds and then the face value. So in this case, we had a premium, so I have to add to it. Okay. So it's 309,000, par value 300. If it's par value 300, we know that that's what bonds payable is, 300. So we know we got to debit that. That's an easy part that you should be able to focus on, remembering how to do that. That if it says the par value is 300, that's my bonds payable. I need to clear it. It sits, it's a liability, so it's sitting as a credit. So I got to debit it. So that's the first part of it. It's telling me that the carrying value is 309,000. So I know that I have to clear off that 9,000. That's a premium, and the premium is normally sitting as a credit, and then we reduce it by debiting as we go. So we're going to do the debit for premium on bonds for 9,000. Now I'm paying out, let's see, exercise is 6,000 on the, so I'm saying I'm gonna pay out 6,000 with the par value. So my payment that's going out, the cash is only 306,000. So make sure you watch what that number says. And then the difference is my gain. Because I was gonna have to pay out more. So the gain is $3,000 and that sits as a credit. And it's just the difference between what I'm paying out and what I had as a carrying value on the books.
Can you explain again where the 306,000 came from?
It tells you in the problem. So it says on July 1, Advocate Company exercises a 6,000 call option on its outstanding bonds. Okay, and right here it says plus par value. So it's saying I'm going to pay you 6,000 plus the par value. The par value
Okay,
is
got that. Okay.
300,000. So you would just add those two together and that's what you're paying out, the 306,000. Now the carrying value is 309. So you have to take the difference in order for the entry to balance, right? So you either have a gain or a loss. So if it said that the carrying value was 304, then you would have a loss on the retirement of the bond, not a gain. Right? Maybe not 304. It would have to be 6. So no, no, it probably has to go more than the 3,000. I don't know that I'm going to have this on the test. I just want you to know that it's out there. And I've never had to fool with bonds, thank God. They're not my favorite, and they're usually not my students' favorites either. They're a little bit confusing. Okay, so do y'all have any questions?